Thanks, Andre. All right, first of all, I would like to thank Glenn and Andre to arrange this opportunity for me to present this paper. And this is a great university and a beautiful university. So I'm honored to give this presentation here. All right, so basically the paper is about China, so something specific in the region, and also make it difficult to publish because oftentimes the referee will get back and say, well, this is only of regional interests, so on and so forth. So, but anyway, the counter argument is China becoming more and more important. So we do this study on dividend payments in China, and the two co-authors are also from Xiamen University. One is my student, the other is my colleague. All right, so the purpose of study is quite simple. First, we try to offer a comprehensive study on the determinants of dividend payments for listed companies in China during the period of 1994 to 2006. And the reason to do that is we do not find any very comprehensive studies. Also, there are some in Chinese local journals, but still I think their methodology, their coverage, maybe not enough, so we offer this one. And also, we emphasize how institutional setups may affect the propensity to pay and the payout ratio in China. There are two papers talking about in China, the dividend policy may be determined by other factors, such as institutional setups, later we'll mention. So that may give different, make the prediction of the payout and payout ratio may be different from the traditional theory, right? And of course, then we first talk about the unique institutional features. Most listed firms in China came into being due to the partial privatization, and the Chinese government is still usually the largest co-investor, or they are still the dominant shareholder or controlling shareholder in these companies. And the government ownership is represented by various entities such as government agencies, state asset holding companies, or SOEs, where the government holding the control power, but it is a business entity, so that may be different from pure government agencies. Yes.
Do you want us to interrupt as you go along and ask questions, or would you?
It's up to you. You can interrupt me.
Are these when you say the government is the largest co-investor? Are they controlling share? Are they active in the management, or are they relatively passive?
Well, that's the way. Actually, okay, you can say they are active because the managers will be picked up by them. And on the other hand, you may also say they are inactive because once they pick up the managers, supposedly the manager will represent their interests. But however, you have the regular agency problems. And they may be even more serious in the sense that the government may not be the good monitor. They don't have expertise. So you may have more serious agency problem. All right. All right. And as we said, okay, those different government agencies may have their own interests to pursue, and they have different incentive and effectiveness in monitoring, management, and their effectiveness can be very different in terms of monitoring. And also, there's a very unique share segmentation system during our sample period. The shares of listed companies had been segmented into two categories, negotiable or non-negotiable. Negotiable means the shares can be traded in the market. And the non-negotiable means the shares which cannot be traded in the market. It's all came into being due to this partial privatization nature. So when government partially privatized firms, what they did is, unlike the privatization programs in UK or other countries, and they will convert existing government assets into certain shares. And those shares are not tradable in the market. Then they will allow the firm to issue new shares to the public in the market. And those shares are tradable. Then the firms can issue the new shares using the proceeds to fund their operations. And the government will not pocket in those proceeds. All right? So that's the way they did privatization. And when they first do this, just because they want to make sure the government have the control of the firms, because that's the Marxist orthodox theory says, okay, the state has to control the firms. So they make it majority shareholders. And then later, they also think, another thing is, okay, it may be better for the public to hold shares when government also holds shares because they provide some kind of co-insurance, especially when those shares are not tradable. All right? And they hold lots of shares, as if they provide some safety buffer for the general shareholders which hold tradable shares. All right, and on average, negotiable shares only account for maybe 1/3% of the total shares. The other 2/3 are non-tradable shares, either held by the government or held by some legal entities, and they are more or less related to government. Of course, toward the later part of our sample, there are some private firms also. The majority of those firms are just government. Yeah.
How does the distinction between the negotiable and non-negotiable relate to the distinction between local and foreign shares, A and B?
Okay, that's different. No direct relationship. The tradable shares further can be divided into two parts, foreign shares and local shares. But they are traded in two markets. One, because they have currency control and capital control. So those shares meant for the locals, they are traded on A share market. Then there's a separate B share market where you issue shares directly to foreigners. All right, and all those are tradable.
So
but
that
that
next level down. You take this 1/3 that are negotiable, and then they're split up into the A's and B's.
it's on average is 1/3. Some firms like those shares that issue foreign shares, maybe they have more tradable shares, especially for those issue shares in Hong Kong. Okay, yes.
Do the shareholders all receive the same rate of dividend payment?
Same rights, same dividend rights, as well as same voting power. The only thing is you cannot do arbitrage between the two markets. Okay, so that's why you see a price difference for either A or B shares or A and H shares, and basically they have the same rights but different prices. Yes.
Just thinking, I'm trying to get my head around the institution here. When I think of this as like there's a family-held firm, and all of a sudden it decides to go out and offer a few little shares out in the market, but the bulk of it's held by the original.
Okay, so basically up until year 2000, there were no private firms issuing shares in China. All right, and then later on, there are some private firms start to issue shares, and also because share issuing basically is still regulated by government, you need to have government approval before you can issue shares. It's not like in the US, you just contact an investment bank, then you negotiate the price. If you fit all those descriptions, all those criteria set by SEC, you can issue shares. No, you still need to gather some kind of approval, especially in the early years, because all those firms would like to issue shares rather than borrow money from the bank. So in order to control the supply of shares in the market, to prevent the market crash, so the government has some quota system. They only allow certain amount of proceeds to be raised in the market for a certain year until toward the end of, say, 1999, they phased that out gradually. Now, theoretically, you can issue shares at any time, but still, I mean, practically, you still need to go through lots of bureaucratic procedure. Actually, you still need to get government approval. Yes.
Okay, still trying to get my head around this. In New Zealand, when I first came here, all of the banks had to hold X% of the stock of their wealth in government. So that's obviously going to affect their behavior because they've got this big constraint on it. And this is something like that.
Yes, yes. We try to see whether that's the case. Okay.
So what happens then if these are like SOEs, basically? You know, they were government-owned firms, now they're still largely government-owned, but they sell some shares to the public. What happens if they also list or subsequently list on a foreign market? Is that then a separate set of shares that they issue, or is that part of this 1/3 negotiable?
No, separate shares to be issued. Yes, sir. So we'll issue additional shares.
Additional
Yeah, okay.
shares.
Yeah, additional negotiable shares. So that's why the percentage of the firms, say, shares which are tradable do vary, but not that much. Okay, and the problem is basically like all H share firms, they first issue H shares before they come back and issue A shares. It's not like the usual case that you first have domestic shares you issue, then you go to the foreign markets. So when they come back, they usually only issue a very small portion, not that big. And for B shares, you can issue first in A share market, then B share market. And but however, some shares, yes, right now there are firms, right now, because since another story later we'll mention is after 2006, they had this reform. And now, theoretically, all shares should be tradable. Okay, they took about 2 years to finish this reform. And in the sense, all right, the non-tradable shares need to pay tradable shares to buy their rights to be traded. But even that's the case, they have to trade gradually over the next few years, not allowed to trade immediately. Theoretically, 2 years after their reform, all shares are tradable. But yet, okay, you can only allow to trade 5% of your shares each year after that. After 2 years, you're allowed to trade maybe up to 5% after that. All right, so gradually, maybe over the next, say, 5 to 10 years, it will be all tradable, basically. Okay. All right, so all those are just institutional features. And then we also have this CSRC regulation. CSRC, just like SEC, the watchdog of government on the securities market. And basically, they require all companies to pay cash dividends before they are allowed to issue basically season offers or rights issues. And the reason of that is they claim is to protect interests of public shareholders. But key thing is there are two types of shareholders. One is non-negotiable, and the other is negotiable. So we would like to see such kind of so-called protection is beneficial to the non-negotiable shareholders or negotiable shareholders. All right. And the above-mentioned institutional features should affect cash dividend payment, and these effects may be different from those predicted in the traditional theory. Why we say maybe? Because there were a few articles, and there are still some articles there, and working papers, and examining at this. So on the one hand, some people argue, okay, like Franklin Allen and Qian, they had a paper JFE. They say Chinese pay their shares, pay cash dividends the cash dividends payment in China is too low, all right, and that is not right, something. On the other hand, there's an article by Lee and Shaw, and Lee is Jevons-Lee accounting guy, and that's still a working paper. They specifically wrote a paper talking about cash dividend payments as a means to tunnel the assets. And what they argue is in China, they say because of the so-called share segmentation system, then okay, the conflict of interests between non-tradable shares and tradable shares is the non-tradable shareholders, they are the controlling shareholders. And then okay, they cannot get any benefit from maximizing share price because their shares are not tradable. So in order to get benefit, they would force firms to issue more cash dividends. And on the other hand, okay, the tradable shareholders, they would prefer more to get capital gains because it's not taxed. And that's why they say, well, that may be the case. And they also argue there's one way they can get by this non-tradability by first issuing rights, have rights issues in the market. They get cash, then use the cash to pay dividends. And in that way, they can sell a portion of the non-tradable shares in the market at market price. And also, another thing needs to be mentioned. The non-tradable shares sometimes, under certain approval of the government, they can be transferred between institutions. But the transfer price is much lower than the market price. It's about, say, 20% or less. All right? So if you can do this, means you can get some arbitrage, say a portion of your shares. So that's what they argue, all right? But however, it may not be true because later we will mention the amount of dividends issued and the proportion of firms who issue cash dividends are not particularly high in China relative to other countries, all right? And Lee and Shaw argue that instead of reducing the agency problem, cash dividends actually serves as a means for controlling shareholders to expropriate minority shareholders in China. And the cash dividends may still be used to reduce agency problem. That's the counter argument. And especially in China, when you have so-called double agency problems or maybe triple agency problems, so on and so forth. Because it's unlike the family-controlled firms in East Asia. All right, in that case, the management, the conflict, agency conflict between public shareholders and management is not that serious because you have a dominant controlling shareholder who can hire or fire the management. So that's not a serious problem. But however, in China, it's different. Although the government has the absolute power to hire or fire the management because they are the single largest shareholder. And however, you still have the agency problem because once you pick up one, you do not know how to monitor him or her, right? And they don't have the expertise. So in that case, all right, you may also see serious agency problem. How to reduce that? paying cash dividends may still be a way to reduce the agency problem. So we want to examine the following questions: whether conventional determinants can still explain dividend payments in China, and whether the likelihood of paying cash dividends and the payout ratios are positively associated with percentage of non-negotiable shares and the percentage of shares held by controlling shareholders. So this is based on what we mentioned, the Chinese feature, right? And also whether dividend payments are more downside inflexible for firms with more powerful negotiable controlling shareholders. All right, if the negotiable controlling shareholders, they want cash dividends, then okay, you will see in China, the cash dividends will be more downside inflexible. All right, and well, of course, in the US, you also argue you have so-called dividend smoothing. So in that case, should be both downside and upside, they are both inflexible. But yes? Tax rate on dividends is about 20%. But yes, it's withholding actually. And withholding at the source. So no matter who you are, they always deduct 20%. Okay. And however, sometimes later we'll also mention, in the early years, many firms would prefer to pay you stock dividends. But stock dividends will also be taxed. Okay, so even if it's stock dividends, they will consider it as a cash dividends. They will do tax that. So sometimes you will see all the firms will pay both stock dividends and cash dividends. They pay cash dividends in the sense to, just to cover the withholding tax. So you don't get any cash, actually. So what we consider cash dividends is the cash you pay is more than the withholding tax by 1 cent. Then we say, okay, you pay cash dividends. Otherwise, no cash dividends. All right. Yeah.
Sorry, I'm just trying to put the basic constraints down. So what is the limit on the A and B shares? They cannot be, their sum cannot be more than 50%, right? Because the government has definitely
Nowadays, no longer. It's phased out those kind of restrictions already. Used to be the case, cannot be more than 50%. And I had a paper about 2002, and at that time, I only found one firm has has foreign shares account for 51%. All the others are less than 50%. So, but nowadays, they have already phased out those kind of rules. And even the banks, they allow strategic partners and so forth. Okay.
on the government share or the domestic share.
Basically, they say, in the law, they just say domestic shares, right? But actually, it's government shares. But right now, they relax those kind of requirement.
So when they pay stock dividends, are the resulting shares negotiable or non-negotiable?
Both.
Could be either.
Could be either. Yeah, and actually, okay, that's a good question. In the early years, they do that. Well, they pay non-negotiable shareholders cash dividends. Negotiable shareholders, stock dividends. Then later, that was not allowed by the CSRC. That's unfair. All right. And also in terms of rights issues, there are some stories too. And because for non-negotiable shareholders, they don't have incentive to subscribe for rights. They subscribe for rights, they have to pay the same price, market price. Because when they first convert their assets into shares, they just, according to some formula, right? And then okay, later you have to use the market price to subscribe for shares. But then the shares you subscribe could not trade. All right? So they did not have those kind of incentive to subscribe for rights. So many of them will say, okay, we contribute assets instead of paying those rights by shares. Again, later was invalidated by CSRC. They say, no, you cannot do that. And you have to pay cash. But then many companies, they skip rights issues. I don't want to subscribe. Again, they have, they have those kind of requirements to say you have to subscribe at least 50%, something like that. Okay. So always have those kind of things. And of course, all those are just related to those institutional setups. Okay. So if non-negotiable shares, they do prefer cash dividends, then of course, the cash payment policy will be, say, less downside flexible. Okay. And also we examine whether different types of controlling shareholders affect dividend payments different, especially in relation to the downside flexibility of dividend payments. As we mentioned, you have controlling shareholders. They can be government agencies or pure government asset management companies, and or SOEs, or even a private company or whatever, right? And we expect their behavior will be different. Okay, and later in the hypothesis we will further mention that. Then we also say whether examine whether the 201 CSRC stipulations benefit negotiable shareholders. What they require is if you do not pay cash dividends in the previous 3 years, you are not allowed to issue new rights issues. You are not allowed to have rights issues, all right? And also how negotiable shareholders react to dividend enhancements. So in that case, if the negotiable shareholders, they do not like dividends, then can be reflected in the market, okay? Especially in extreme situation. Say you have a big increase in dividends, or a big increase in earnings, or a big decrease in earnings. Then you can see, okay, those companies, they increase dividends, omit dividends, or decrease dividends. What will be the response in the market? And in the market, the response only reflects whose views? Tradable shareholders' views, or negotiable shareholders' views, all right? So those are the things we want to examine. Then this is related to, but different from existing papers, of course. And I don't want to spend too much time on this. And we have some difference because they have single country studies, and we also have this is also a single country study, but however, we focus on privatized firms, which is different from the others. Then they have lots of cross-sectional or cross-country studies, and basically we borrow from them. They have lots of determinants across the countries, right? Then we try to see what are the common determinants, then we borrow those things in our study and see whether they are still the common determinants. Yes?
Just going back, when you said the stipulation was that if you didn't pay dividends in the last 3 years, then you weren't allowed to have these rights issues. Did they also have a requirement about the ratio at which you had to pay the dividends, or is it just any minimum payment?
Minimum, they didn't specify what is the ratio, right? So that's why we examine both the ratio of payout and the propensity to pay later. Okay. Then also there's some debate, right? Alan, Chen, they say the cash dividend in China is underpaid, all right? And the Li and Shaw say it's overpaid. So we use a more comprehensive data set. We try to assess whether Chinese firms pay too much or too little in cash dividends, and also in relation to the studies elsewhere. And basically, Li and Shaw, they only use 1993 or 1996 to 1999 data, very short specific sample period. Then they find evidence in supporting of their hypothesis. Then we will try to argue that may be sample specific. So we expand that and see whether that's the case. Institutional background, just now we have already mentioned most of them, so just skip. And basically, okay, we will, from those institutional setups, we will see, okay, we would like to conclude that institutional settings in China have conflicting impacts on dividend payments. So managers may want to pay no or few dividends, right? Because they can have more perks to consume. And the controlling shareholders, most of them holding non-negotiable shares, would like to receive cash dividends. And the negotiable shareholders, they prefer capital gain over dividends. So basically, that's what we can say. And the hypothesis. The first set of hypotheses, likelihood of paying dividends, which is a propensity to pay, is positively related to the proportion of non-negotiable shares. Okay? And also the payout ratio is positively related to the proportion of non-negotiable shares, or the power of the number one, the largest non-negotiable shareholders. Right? And second set, firms controlled by government agencies or asset management companies are more likely to pay dividends than firms controlled by a business parent. And this is based on the assumption the business parent may have alternatives to extract cash from the subsidiaries. Okay? While the pure government agencies, they may not be able to, or they don't have incentive to do that. So in that case, okay, we would say, well, if it's the parent is an SOE or other private entity or whatever, they have their own interest to pursue, and they have other business related, then they may be more flexible in terms of cash dividend policy, because they have other ways, alternative ways. Of course, this is based on the assumption they can divert cash from the subsidiary. If the tunneling or the way the embezzlement is impossible for those companies, then you won't see that. Okay, yes?
I wonder if the government owner is sort of, is it always central government, or is it city governments or province?
Oh, it can be all. It can be mixed. Yes.
If it's a state government that's they could extract their rents by having a higher dividend payment, or if they're worried that there's too much unemployment, just say, well, we've got this free cash, we're going to hire a bunch of people to do nothing. We're going to ask the manager to make some investment decisions that are too labor intensive.
New Zealand Rail.
Okay, yeah. Adopt some more inefficient processes so that employment stays up and we get to keep our job as local city council or regional council. In that case, you'd expect a lower dividend payment in these kinds of setups, but I wouldn't expect that coming out of the national government as much. So are you going to be looking at level of government ownership within these non-negotiable shares, or is there any chance of this kind of thing going on? There's some reason that I went to lunch and worrying about this.
Yeah, that's a good point. We have not done that, and it is possible. We just need to search the database and try to classify all the different governments. It's possible to do that, and that's certainly something good to look at. So you can see the different government may have different objective functions.
You'd expect that a local government facing higher unemployment will pay out a lower dividend, controlling for everything else.
But on the other hand, all right, the institutional setup in China is a bit complicated. On the one hand, they have those kind of local authorities overseeing all those kind of so-called state government asset bureau.
Yeah.
But they have a vertical guidelines also, because you have at national level, they have a so-called a state asset management. What's the state asset? Well, I don't know how to translate that. Okay, so they overcharged all the big enterprises. Then the rest, they also need to follow the guidelines set up by the central authority. So the local government do have some influence over them. It's possible they may want to rescue the local companies by requiring the low, say, dividend payments. It's possible. Yes, certainly it's a possibility, but we have not done that.
But couldn't you measure that by looking at the employment? Yeah. Because this New Zealand Rail thing was a classic thing. When they privatized New Zealand Rail, I think they went from 25,000 down to 5,000. And I mean, I remember meeting a local manager who was responsible for selling off land assets down.
No, the problem, look.
And they literally, he would get requests from Muldoon saying, we want another 600 people hired.
No, the problem to do that is we cannot associate those kind of things too much, in the sense this is just a sample of all the firms. Listed companies are just a small number of companies. What if main unemployment is due to other companies? Even if they have those policies, they cannot hide that much. Okay, so we cannot associate that much. You can't associate it with those kind of things, but may not be too much. Okay. Because you can see, okay, in a certain area, the unemployment level, then you can look at that. But if you want to direct associate it with this small sample of listed firms' dividend policy, may not be that direct, so that the relationship may not be direct. On the other hand, and yeah, okay, that will be too much. Okay, I just proceed first. And the second set is H2B is pretty much the same, just okay. So the first one is agencies. The second is high payout ratio. The first one is just a propensity to pay, and this one is talking about different parents. They may have different behavior. Given a large decline in earnings, firms with the government as the controlling shareholder have a lower likelihood of omitting or reducing dividends than firms with a business parent company, right? And you can observe the opposite if they do not have the ways to extract cash from the listing company. Then they will have the incentive to extract more, right? The parent companies, all right? So this one is the same thing, okay?
This is just in general true, right? I mean, if not caring about who owns it, who the controlling shareholder, it's generally true that with a decline in earnings, there is a lower likelihood of
no, the chance will be a bit higher, but however, in the US and also in the dividend policy literature, they will say, well, you have dividend smoothing. So unless you have very bad years you forecast into the future, you will not cut your dividends.
Right.
All right.
So I guess what my question is did you look at, just a little quick and dirty, is this more so than in other markets?
Okay. Actually, empirical evidences are not clear. It's mixed. And in the US, they say income smoothing is more common. But in Europe, like Germany or whatever, they have very flexible dividend policy. Okay.
Right.
Mm-hmm.
What proportion of a local government's assets are going to be held up in the non-negotiable shares of local firms?
You mean?
So let's say you've got a local council or a city council. What proportion of their revenues is coming out of these kinds of dividend payments?
Won't be very large.
Okay.
It won't be very large because actually the dividend, all the dividend they pay, remember altogether we only have about 1,500 listed companies. And the larger ones will be controlled by the central government. Okay, so the local ones won't be that much. And actually there were competing hypotheses. Many firms, instead of talking about the predatory government, they are talking about propping government. The government will prop the firms up to have some image of the local economy, so on and so forth. So, but nothing is concrete. Okay, so the
If you had a city council that was fairly reliant on dividend payments, then you might see this affect a lot more
no,
than with the central government
no.
being the owner, because it would smooth across different
No, they won't.
tiny proportion of revenues anyways, they're not going to
They won't, because first of all, the dividend payment is, in terms of percentages, always lower than 10% of their price, right? So, second, and many firms do not pay dividends, and also certain government have owned more listed companies. Then other provinces, they own very little, listed companies. It's unevenly distributed, so that's difficult to say. Usually the proportion-wise will be very small. The largest source for the local government is selling the land, especially in those big cities. Okay. All right, so for that, the market responds negatively to the announcement of an increase in dividends, and when the firm incurs a loss or has a large decline in earnings, if there's no earnings smoothing, okay? And also the market responds positively to the announcement of increasing dividends, and when the firm becomes much more profitable, okay? And finally, we just look at the CSRC stipulation, okay, which requiring cash dividend payments as a precondition for rights issues, whether benefits negotiable shareholders, especially the shareholders of firms that are profitable, but only pay cash dividends infrequently. So if some firms, there's those tradable shareholders, they do like dividends, all right? So if you have some so-called clientele relationship, and the poor people like to receive dividends, so on and so forth, and then, okay, and it will be reflected in those kind of firms, say, they rarely pay dividends, although they are profitable. All right. Now they require you to pay dividends, right? So those negotiable shareholders will react positively. All right. All right. So those are the hypotheses. Then the data, and we get data from those kind of databases. So right now in China, there are many competing database companies. So they provide pretty good data, and because with comparison, you can see which data is better or worse. Over time, they will compete with each other. So now the data is quite comprehensive, and also in a timely fashion. All right, they copy CompuStat words, and also CISP, so on and so forth. So our sample period starts from 1994 because cash dividends were fixed and mandatory for many firms up to 1993, right? Because Chinese stock market established in 1990 and 1991, and at that time, investors were risk averse. So some stocks, they call them stocks, but actually just like a bond, they have mandatory dividend payments. All right, but 1993, they abolished that, okay? And also the year 1993, CSRC established. So we take data starting from 1994 onwards, okay? And this is a sample selection process. So we start up with all those firms and about 12,000 something. Then we end up with about 8,100, okay?
So what are these 12,000? These are...
Firm year. No, that's just firm year data. Those are accounting data, no matter which stockholders. Okay.
Right, but like when you, okay, so you're just, you had 12,000, well, let's go to the 8,000 companies.
Company years. Year, okay.
But, so then within those company years, you've got all these different classes of shares, these categories of, you've got the non-negotiable.
No, each company you have non-negotiable, non-negotiable, yes. Mm-hmm.
And so you might have then 16 16,000 different per year types of shares you're looking at.
No. Oh, in terms, because we run regression, we just put variables on the right-hand side. If it's negotiable or non-negotiable, we don't need to separate them.
Okay.
But then, of course, we can compare in the univariate test. Yes, we compare, we separate them. Yes, okay. Yeah.
My question is why you exclude the firms with H share listing?
Oh, okay. The dividend payments may be different because if you list in a foreign market, then you have to follow, you have to. No, they have dual listing. They have dual listing.
Yeah, you mean the dual listing.
Yes.
Market.
Yes.
And then you exclude those
Firms with dual listing.
because they have.
Because they may follow Hong Kong practice, which may be different from mainland practice in terms of dividend pays. Again?
Does that mean, is that influence H share dividends also influence the A share dividends? I'm not catch.
Well, yeah. Because dividend policy is the same. If you pay H shares certain cents, you need to pay A shares certain cents. Always the same. So if you have an H share listing, then okay, they may follow because the majority of tradable shares are in H market, Hong Kong market. So if they follow Hong Kong practice, then okay, to Chinese firms that may be an outlier. Okay. Yeah, we exclude them, but because they are small portion for the dual listing, very small portion. It doesn't matter. And for H shares right now, up until year 2007, there are about 105 firms on the SEHK, and only half of them have A shares. Okay.
Those 105 companies,
Mm-hmm.
are they also these primarily state-owned companies, or are they primarily private, or is there?
Okay, up until year 2002, all those are primary government companies. After that, they allowed private companies to list in Hong Kong also. But in the SEHK, which is the main board, not many private companies. On the other board is called Growth Enterprise Market. That's a very small, those market for those innovative firms, and then lots of private companies.
When you're excluding them, is it just off the cuff, is your subjective belief that they have different dividend policy, very different?
No, we just want to focusing on the Chinese investors, okay? Because those may be influenced by the customers in Hong Kong market. But however, as a robustness test, we including them back. It doesn't make much difference, so it's okay. And the B share market, we didn't exclude B share market just because they are also in China. Then later we exclude them, the results are still the same. So that's okay.
So the US listings that Claire mentioned, are they included in that 274?
Which one?
US listings, firms that are cross-listed,
Uh-huh.
are they included in the 274?
Yes, 274 year firms.
Hong Kong dual listings, it's everywhere.
Yeah.
Firm year where a firm was.
No, basically only Hong Kong and New York, they have some dual listing firms. For others, they usually do not. They have listing in Malaysia also, and in South Africa also as one firm. But in US, there are about, I think 2 years ago, there are about 40 some firms, but only 7 firms have dual listing. And the dual listing is usually either with Hong Kong or with mainland China. Okay.
It's a very small number, isn't it? Because that's 274 firm years.
Firm years.
So 14 years, so.
Yeah, but because we started to list in Hong Kong in 1993, the first batch only 6 firms. And not all the firms have A share listing. They first list in Hong Kong for many years before they have A listing. So it doesn't matter, right? Only later years they have A listings, we need to count for them. We need to exclude them. Before that, it was not included in the sample in the first place. Yes?
First thing that I would think, if I was expecting there to be different effects between Hong Kong and China markets, would put it all in and then throw in a dummy variable for whether you're dual listed. Is that what you did when you brought them back in?
Yes, we did.
Is there any significant effect?
Not much difference. Yeah. Okay.
Oh, that's a result too.
I'm just wondering where did you get the data about the shares people listing or multiple listing?
Well, okay, that's you can go to the SEHK website, and also China CSRC website, And CSRC website used to provide a list of all the 8 share firms. Okay. And also, you can go to US, you can go to DataStream, and you can get it. You type N, okay, you can find out. Okay, and Chinese firms may not be complete, the list, all right? But however, but no, DataStream is not complete. But for Chinese database, like Reset, it's complete. And also CSMAR, they also have, all right? And these are the things, the data sources, you can get them, all right? And
why is there such a high percentage of observations with missing data?
no, because you have so many independent variables. So once you miss anyone, you have to take this out, okay? And that's okay, because many people have even more omitted data, so that's not too much. And another thing is, okay, in the US, people would argue the utility firms would pay stable dividends. And okay, we didn't take them out, but later we'll also take them out. And then main results does not change, all right? So we just add them. And also in Chinese, all those kind of documents, they then mention utility as a separate group, okay? All right, so those are the statistics, general statistics, and that number of firms, sample firms, all right, counted, and new lists every year. Those are the things we can get data, all right? It's not the whole universe, and just in our sample. And not many firms are delisted, all right? So only start to delist firms in recent years. Yeah, because due to what? Due to the share segmentation reform, that means they try to converge 2 types of shares. And what they do is the non-negotiable shareholders will pay off the negotiable shareholders to allow me to trade my shares. So what they do is they will send you, say, for every 10 shares I have, okay, I will give you additional 3 shares for free. So the company will issue 3 shares for free to you, but not to me. So in that case, you get compensated. And these 30%, because are issued to the to the existing shareholders, right? They can start to trade those shares. So in order to prevent too much shares to be traded in the market, not many new shares issued in those years, all right? That's good observation.
Second column, sample firms, that's the number of firms. So in 2006, you had 1,018 listed firms in the sample.
Yeah.
Is that right?
Yeah, so
I'm just wondering how you get that 950 the previous year when 8 listed and 12 delisted. To me, that would read a loss of 4, but you've actually had an increase of 58.
okay, no, because as we mentioned, you have excluded many observations. But when you're talking about
Oh, I see.
yeah.
So some of them come back.
Yes, yes,
Oh,
okay.
right.
Okay.
How about in 96 to 99, it seems to have flip-flopped between payers and non-payers, you know?
Yes, I don't know either. So that's why, okay, we say, okay, the pairs, so these pairs and then pairs basically is a classification according to pharma and French. They divide them into cash payers and non-payers. So this is for payers, and this for non-payers. And for the non-payers, we further divide them into never paid and ex-payers, all right? And these 2 numbers will add up to 100. And from here, we see, all right, these 2 years, the payers are the lowest. Then later, they increase, fluctuating, all right? No particular pattern you can tell, okay? And for non-payers, of course, this is a mirror image. But then for never pay, okay, become less and less, which is also understandable. And ex-payer, and or ex-payers plus this one should equal to this, okay? So basically that's the, and the new lists that pay, it's very high percentage in China. So that's quite different from D'Angelo and D'Angelo. Basically they say young firms, and they just had IPO, usually they do not pay dividends because those are capitals raised in the market. And they only pay when they accumulate a lot of earning, capital, retain lots of earnings. Yeah, but here we don't see that. But then that's also backed up by some findings from Magginson. And they did some studies on privatized companies. Then they find, okay, for all those privatized companies, they tend to pay dividends on the year they issue their shares. as a gesture toward the general public or whatever. And our firms are mostly privatized firms. So this is consistent with what they find. And also dividend premium is something from Baker and Ugler in the new paper, and talking about the firms are catering to the investors' tastes. What they try to measure is they use valuation of the shares which pay dividends and shares which do not pay dividends. Then they compare the variation, basically use mark-to-book value of those two groups. Then they divide them or just subtract one from the other, and then they get the so-called dividend premium. All right. So if the dividend premium is high for those cash payers, then the management will start to pay cash dividends because the price value will be higher. All right, if they want to maximize shareholders' wealth. On the other hand, they do not pay dividends. All right, and from here we see it's mostly negative, and also do not co-vary with those kind of payers and non-payers. So in that sense, it's also understandable, and because the largest shareholders are non-tradable shareholders, right? So basically, they do not want to catering to any tradable shareholders. They want to cater to what? Cater to those controlling shareholders, right? So here you use tradable data, which of course do not reflect anything. Okay. Then the payout ratio, of course, this is talking about all, no matter you pay dividends or not. You take out all those kind of profit as a denominator, and dividend, total dividend paid out as the numerator. Then this is the number. And this is the denominator using what? Using only payers. Then surprisingly you find, okay, sometimes, okay, this is higher than this, and sometimes this is lower than this. So this says, okay, many of those firms which do not pay, actually what? They are losing money. Okay, so they are not profitable companies. So here it suggests maybe the profitability is still a very important determinant for cash payment rather than just shareholding system. And those are the univariate statistics for mean and variance for all those proxies for profitability. The first two measures is EBIT over total assets. The second one is net income over book value of equity. So those are all used by Farmer and French. And this one is like Q, just the value of the firm over total assets. And then total assets there, okay, total assets. And SEP is a standardized value for standardized proxy for size. So basically, if you just use size, then over the years you have inflation, and it's kind of difficult to compare. What they did is they take all the firms, counting their percentage in NYSE every year, say how many % of firms below you. So we borrow their methodology and calculate the same thing for Chinese stocks. Then, okay, you can standardize all those things. It's a measure for size here, and the retained earnings, and this is the debt ratio. This is non-tradable shares as a portion of the total shares. And also, this is number one shareholding, how many percentage of shares they hold. And this is a expense. And this expense is something special because usually when people want to measure agency problem for the dividend policy, they use free cash flow. And the previous papers document free cash flow in China is never serious, or never significant in all those regressions. So that may not be a good proxy. So from accounting literature, there are some guys published paper in Journal of Accounting and what policies, I think. They used two proxies. One is the admin expense plus the sales expense divided by total sales. Then they say, well, that is something including lots of perks. And there's additional one, is called, we call them direct perk, is so-called additional sales expenses. All right, then we pick these two out, divided by total sales. Because most of the perks are just, say, entertaining their clients, and they're using various excuses so they can spend those perks. So these are the things that we pick out. Then this is SEO the year before, season equity offerings. If it's offered, then it's 1. If it's not offered, it's 0. It's dummy variable. And this is also the year after, all right? Because it is also possible we'll pay dividends just in order to later I can issue shares, okay? Okay, so summarize those kind of data, okay? So payers are usually larger, more profitable, and have more retained earnings, so which is consistent with the previous literature. Then payers also have lower leverage, consume fewer perks, and these characteristics associated with payers are consistent with conventional dividend determinants documented in the literature, right? Then payers appears to be associated with high percentage of non-negotiable shareholdings, large controlling shareholders, which is consistent with the conjecture that dividends may be paid to take care of non-negotiable shareholders. And also the relationship between FCF, free cash flow, and dividends is not clear. And this correlation matrix, later on we'll eliminate some variables just because they have high correlations. And finally, we want to use a Tobit model to examine simultaneously the propensity to pay, that means whether to pay or not to pay. The other is the payout ratio. We study them together, all right? So those are the formulas. The first one is selection equation. The second one is the OLS equation. So we're including the same independent variables in both equations. But this morning, Bob told me that's wrong. They say, okay, usually the second one should only including a subset of the first one. They say, okay, that will be more accurate. And I need to think it over and see whether we can do something on that. Of course, easily we can drop all those things ex post. We see which are not significant. We just drop them, then fabricate some stories, right, as if it's ex ante. And but so far, okay. I need to refer back. Probably he's right because this one is copied from Italian. Two Italians, they wrote a paper talking about foreign listing. Then they have the firms, why they want to go and list overseas. And also if they list overseas, how much proceeds they want to issue. And so they simultaneously examine these two, they use Tobit. And what they argue is, okay, they see the one set of determinants should be the same set of determinants of the other. They don't see any difference, so that's why they include them together. So we just follow them, okay? We do the same thing, but then it's good. Okay, Bob pointed out that may be some econometrics problem, so I need to look into it and see whether we can do something. But however, it's not too difficult because they only say this one must be a strict subset of the first one. So it's not that difficult, all right? It's not something they ask you to do some more complicated stuff or prove something. Okay. So those are the selection equation. Basically, those are the determinants. You see size, growth opportunities, earnings power, leverage, and whether you have issued rights before or after, and also the non-negotiable shareholders, either this one proxy or that proxy. Okay? Yes?
Did Bob ask anything about you dropping variables based on the correlation matrix earlier?
No,
okay.
Didn't say.
Bob knows a lot more econometrics than me, so if that didn't bother him, then it shouldn't bother me.
Okay, then let me know your concerns. So well, maybe I can revise why.
You got a couple of variables that are collinear, and you're going to have collinearity, but you just drop one of those. You've got a variable bias, and collinearity doesn't induce bias; it just increases variance, right?
No, the key thing is they are alternative proxies. They have many alternative. Okay. There are many alternative proxies, like the first two. So I just drop one.
But if there are alternative proxies, then why are you having to run correlations between them?
No, because key thing is you may have this set, two variables are alternative. Then there are another three for the proxy of the agency. Yeah, exactly. So they.
I understand.
But then will that also cause problem?
You'd have to ask Bob.
Okay.
That's fine by me.
Yeah, well, yes, may still cause problem, but I don't know what are the better way to handle this. And usually when I do this, I just try to. Yeah, because multicollinearity is always a difficult problem. Okay. All right. So this is the first set. Then the second set, I just try to add in something like whether it's government owned or it's a, say, parent firm. So if it's pure government asset management bureau, or government agency, then the GOV equals 1, otherwise 0, all right? And then further one, I want to add in, say, downside flexibility. So D is a dummy variable if the earnings drop by more than 70%. So the key thing is that we want to look at those interactive variables. See whether during this situation, whether if it's, say, controlling shareholders is very large, whether they will tend to still pay dividends or not. Mm-hmm. Mm-hmm. It doesn't matter. Don't be too modest. Anyone's fine.
I'll make mine quick. If you're interested in firms that have these big positive or negative shocks to earnings, does it matter much what the path to get there was? So you'd expect there to be very different effects on earnings if you've just got some firm that's got highly variable earnings compared to one that's had pretty stable and then a blip upwards.
Okay, that's a good point. Yes. Mm-hmm.
Well, if you've just got one that's got back, then
mm-hmm.
dividends are going to follow a different path. You'd expect them to try and smooth.
Mm-hmm.
But yeah.
So, yeah, that's a good point, but just some kind of rough examination here. So I do not know. But in that case, as Glenn pointed out, you need to have what is the normal dividend payment path.
Well,
but that will be difficult to figure out.
I'm more worried about variance in revenues than in the dividends for the right-hand side. And you'd be wanting to do something like, instead of 70% increase or decrease in earnings.
No, basically, we only want to look at a decrease. So one thing possible can get rid of your problem is it's negative earning. Then everything's fine. But key thing is, we tried negative earnings also, but then why we want to use 70% drop? Just because if it's negative earning, then you chop off lots of samples later on. Because in those if it's negative earning, then no firms in our sample will increase dividend in such kind of situation in our sample.
Something simple like just what's the standard deviation in that firm's earnings? And if they've had a shock that's more than 3 standard deviations out or something, or 2 standard deviations from their expected earnings, then use that as a criteria.
But that's also troublesome because we only have maybe 14 years data. And then some firms may only have 3 years data because it's listed at different years. So this will be, and
some of the papers that you're criticizing only have 3 or 4 years data anyhow, but then you can, why not take that? I like that idea.
Well, okay. Key thing is what we dealt with this was we vary the threshold, 70%, 100%, or 50%. So if it's 100%, I thought okay, it's a psychological threshold. Because you drop it by 100%, then earnings turns negative. So that will be a strong argument, I think, rather than you try to figure out some kind of normal dividend paying price, because that's always debatable. Okay, and we did all 3, then find similar results. Also, we report 70% down for the earnings, just because later when we do event studies, we need to have more observations, so we just keep the 70%. Okay, yeah. Mm-hmm, yeah, inverse Miller ratio, yes. Mm-hmm.
Would you both know that you were not worried about selection, that this was just technical? Because I don't think you need to analyze.
No, what he says, okay, when you have this selection equation, okay, then for this one, okay, you have inverse Miller ratio. If you do not, you contain the same set of variables, it's based on the structure you select. All right, whenever you select, the Miller ratio will change. That's what he argues. So I need to read back and see because, and what I did is we just have those kind of package. We just throw in the garbage and then garbage out. Okay, so we don't really look into all those kind of details. And I did read Green had a whole chapter on this. I did read that, and I did read that. And however, they are talking about something different. They are talking about sensory, and they not quite usually you put 2 together. Usually they just have 1, all right? So we just simultaneously went to, and this one I look into, and definitely I will look into it and to see whether we can do something like this, okay? Or whether that's totally wrong and spurious results. We need to redo everything, okay? But even redo everything is not that difficult, just recompile the paper, recompile the tables, so because data are there, okay? Okay. Okay. So the results and the multiple regression results, and surprisingly, all those kind of traditional measures, they're all significant and at correct sign. All right, and since the data is observation are quite many, so we use 5% as the threshold. All right, because one thing with large sample is everything could be significant, and so we just use 5%. Even if you use 1%, you see most are significant. Okay, and then okay, size is positive affecting dividend payment behavior. This is pay or not to pay. So the larger size, more likely to pay. That's consistent with the previous argument. And if growth opportunities are higher, then tend not to pay. And earnings are higher, tend to pay. If you have large, if the negotiable shareholders percentages are large, then you tend to pay, right? And you tend to pay here. Free cash flow, no impact. Then, okay, perks, negative impact. So this is okay, right? Substitutes. So if you pay dividends, you consume less perks, okay? And then leverage, again, it's a substitutes to dividend policy because you can use dividend policy to reduce agency problem. Alternatively, you can use what? Debt to reduce agency problem. So they can be substitutes or what? Complements. Because substitutes, they have many arguments, say, if you use dividend to pay, then you don't need to borrow that much. On the other hand, if you borrow a lot, they have covenants, restrict you from paying dividends, okay? And they can be complements also, in the sense, okay, you paying cash dividends, not reduce cash dividends, not reduce free cash flow enough, so I further borrow, all right? And here we find it's negative, so substitutes. And surprisingly, the previous author, like Li and Xiao, they find this one is positively related with this, with the dependent variable. Then we find it's not. On the other hand, hey, 1 year later, whether they have a rights issue, it's positively related. So that's just opposite to their argument, but however consistent with later the CSRC requirement, because you pay dividends as a precondition to issue. All right, and this is for the payout ratio, pretty much the same. So except these two are not significant, okay? And so I'm thinking we'll chop off these two later, okay? And yeah, all the others are pretty much the same, okay? Then table 6, we're adding a government here. They are unanimously insignificant. All the other results are the same. So, okay, the identity of the controlling shareholder doesn't matter. It could be a government, or could be a state-owned enterprise, or even a private entity. It will not affect the propensity to pay or payout ratio that much. So that's surprising. Okay. And finally, we want to look at the downside inflexibility. So this is, again, within expectation. When you have a big decrease in earnings, it's all negative. So all firms tend to omit their dividends. And later we'll also see the cash dividends payout ratio is also smaller. So when you have bad time, many firms do not pay, okay? And however, when you look at those kind of interactive dummy here, they are all insignificant. So that's, again, okay, it's not within our expectation. And seems, even if you are very strong or powerful, you do not tend to force firms to pay when economy is bad, when you do not earn income or income dramatically dropped. So that may be saying the current Chinese government regulation is quite effective, okay, to protect the negotiable shareholders or whatever. Yeah.
No, just thinking the interaction term B star GOV.
Mm-hmm.
Okay, there's a consistency of the sign, even if they aren't.
Mm-hmm.
So I'm just trying to work out whether that's got anything to do with Eric's point about how. I mean, can you explain the GOV variable to me again? Just
GOV is if the control shareholder is a government asset management bureau or government agency.
yeah. And so in this case, it's saying if there's a big shock and it's a government thing, the dividend payment is going to be less.
What proportion of your observations have that as being one? Is it like half or is it like 90%?
No, less than half. That's about 30%, something like that.
I was just
25 to
I was just worrying about collinearity between the interaction term and the other term. Maybe if collinearity issues would make both end up being significant.
Oh, we did check. After we view these results, then we take out those. It's not reported. We check it's not that high, the multicollinearity. Yeah, because we also find this is strange because we expect to find some things. We thought this is something interesting if we can find these results, but we cannot. Okay, we did check. So after that, I asked the other co-author to check immediately. So it's not due to the multicollinearity problem. Okay. All right. And yeah, this is for the payout ratio, and pretty much the same. You don't see those kind of anything significant here. Okay, this is negative, and but not all are significant. Only one significant. Okay. Okay. Now we further look at the market responses to dividend enhancements. Oh, it's what 4:30, right? Yeah. Okay, so still have time. Huh? So we use event study to examine how investors respond to dividend omissions, decreases, and increases in each of the following two extreme situations. So first is we limit the observation to firms that have significant declines in earnings. That is, firms with earnings that decrease by more than 70% from previous year, and they're also increased by 70%. Why 70%? Just consistent with previous one. And if we use 100%, then okay, for earnings increase in this situation, we don't have observation. Okay, and so these are the results, event study results. Why they have this one here? Cannot get rid of. Anyway, that's fine. All right, so basically we look at this is for the whole sample. We have 3 windows, -1 to +1, -3 to +3, and -10 to +10 days. And that's just standard event study, and we used. Then we find, okay, for the first situation where you have 70% decrease for your earnings, nothing significant here. Okay, so however you may argue for the dividend increase, the sample is too small, only 19 firms, but still it's indicating for these only 9 or 10, then we omit that. All right, and for those things, again, we don't see anything significant. So it means when earnings drop significantly, whether you increase dividends, decrease dividends, or omit dividends, investors do not care that much. All right, and when you increase by more than 70%, then you find, okay, basically for dividend decrease, you have significant positive response, and here too. And this is a bit different. Okay, this is first sub-period. The sample size is not that large, 48. Then when you have dividend increase, and you have positive response for these 2 periods, these 2 windows, but not this one. And for this one, anyway, even if that's true, it's within expectation. When you have increase in dividends, and when you have increase in earnings dramatically, then you increase dividends is fine. Okay, but these things are out of our expectation. All right, so basically that suggests when you have big increase in dividends, the firms reduce their, when you have big increase in earnings, the firms reduce their dividends. Investors, negotiable investors will respond positively. So that means they may understand that as the companies will retain earnings to reinvest in those kind of more profitable opportunity investment projects, so on and so forth. All right, so that might be the explanation. But again, okay, sample size 63, 76, not that large, so only have indicative value, nothing fantastic.
Would you be able to investigate that? You know, look at those 63 and 76, those firms, and see if, you know, somehow try to determine where it was that they had just these great positive net present value opportunities, and therefore that is how the investors were responding? Or could you?
It's one possibility is you use CAR, then run cross-sectional regression to identify some characteristics. And what we didn't do, why we don't do that is just because the paper's already too long. So, and it's yeah, well, it's and also yeah, it's only 63 and 76 firms, so may not be that worthwhile. So, yes.
Can you I think it was Dividend Premium who that on one of your quiz titles. Can you relate that to anything here, or the
Oh, dividend premium. Dividend premium is something like a macro. The whole market, you only calculate one dividend premium. So you cannot calculate for each individual firm.
Oh,
Okay. All right, so finally we'll just test whether this 201 CSRC stipulation and how they will affect market. And again, okay, we restrict to two situations. First is because stipulation is 201 March, so we restrict all the firms which should be positive, have positive earnings in year 2000. It's about 788. And then, okay, we find, okay, the response, if there's any, is negative. So basically, those kind of stipulation do not benefit the negotiable shareholders. And probably they actually benefit whom? Non-negotiable shareholders, because that may be an enticement for the non-negotiable shareholders in the sense, all right, they require you to subscribe rights issues. So they want to give you some kind of benefit by paying you some cash dividends. And of course, that's, again, just a possibility. We do not have further evidence. And then further, we want to restrict our samples, okay? For the past 3 years, those are positive, the firms paid positive dividends. The firms have positive earnings, but only paid dividends once out of the previous 3 years, all right? So if negotiable investors would prefer dividends, then those firms should respond most positively. But then you don't see anything significant. So again, that shows this stipulation, okay, did not benefit negotiable shareholders. So I think that's all about my presentation. The conclusions I have already mentioned them. So I think it's just roughly the time. And thanks for bearing with me for this presentation. If you have any other question. Yes?
When I think about